Hey everybody, hope all is well. I've got part two of our Finding Unbiased Financial Advice. Today we're going to talk about all the different licenses. Okay, so we've got in the previous class, we talked about the different types of advisors, and now we're going to go into the licenses and all the different tools required. So when we look at all the different tools, you're looking at things like ETFs, income annuities, mutual funds, life insurance, bonds, wealth accumulation annuities, which are becoming real popular now, even stocks and reverse mortgages. These are all just financial tools. And when we talk about being unbiased, these aren't all good and they're not all bad. And we can't just look at them other than tools. A good unbiased financial advisor might reasonably say something is good for you or bad for you, but that doesn't mean the tool itself is bad. I know plenty of people that bought stocks that lost their money. I know plenty of people, well, not plenty. I know somebody who took out a reverse mortgage, cashed out the equity, went to the casino and lost every penny. Doesn't mean the tool is bad. Okay, so we have to be careful about these biases. You might not like the word annuity. Your advisor should not have any of the biases that are out there when it comes to these tools. Annuities are out there for a reason. Reverse mortgages are out there for a reason. Stocks, bonds, mutual funds, ETFs, they're all out there for a reason. These are the tools that we utilize to invest money and grow. Okay, so we have to have different licenses to be able to work with different tools. So if you're looking for unbiased advice, then they have to have proper licensing. So that's one way right there for you to figure out whether an advisor has a bias or not, because if they're only licensed for one type of investment or financial tool, then they're going to be biased because they can't really talk to you about anything else. So in general, we have securities licensing to handle all of the risk-based investing options that are out there. Then we have insurance licensing to handle the no risk, and that's where the line in the sand is drawn. There cannot be any market risk for an insurance licensed product, okay? Securities products do include variable annuities and variable life insurance because those do have market-based risk, okay? So securities licensing is required for those two types of insurance products because they have risk. But anything that doesn't have risk can be in the insurance side, okay? So let's start with some securities licensing. The licensing is different if you're a captive agent. If you're a W-2'd employee at a company, you have one type of licensing, and then there's the independent licensing that you'll have to worry about. So if you are a captive agent or if you're sitting in front of a captive agent, ask them what type of securities licensing they hold. If they tell you it's a Series 6 license, the Series 6 license is known as a limited investment securities license. They are only allowed to manage mutual funds, variable annuities, and variable life insurance, and that's it. They are not allowed to talk to you about individual stocks, and legally they can't even tell you to sell an individual stock, okay? So we do have to understand that if we're working with a Series 6, all they want to do is throw you in mutual funds and a few variable annuities here and there. Then there's the Series 7 license. This is the general securities licensing, okay? This means they can do everything from options trading on down to stocks and bonds and mutual funds and ETFs and everything in the risk-based world the Series 7 can do, but they're still an employee, okay? So Series 7 license is the captive, it's the kingpin at the captive agencies, at the employers, okay? When we go to the independent side, there is a focus on transparency. There's a bit of a security barrier in here for any individuals using independent advisors. And really the only difference between a Series 65 license and the Series 7 license is one simple thing: commissions. The Series 65 cannot take transactional commissions from your money. Okay, the Series 7 can. So in bond transactions, they can't take the commissions between the buy and sell price. Okay. They can't take the mutual funds. Okay. Which we'll talk about in the next week. Okay. We'll talk about fee structures and how they make their fees. The Series 65 can't take any of the front or back load commissions in those mutual funds. So they still have the ability to do options trading and all the other fun stuff out there. They can advise you on everything, but they can't take the transactional commissions. And they also have to register in the state they're doing business in as a registered investment advisor. Once they reach a certain level, it's also SEC covered as well. But the big key here is a word that's thrown around way too much. What is a fiduciary? Well, a fiduciary is a Series 65 license. Okay, they are required to be legally a fiduciary. Okay, they are your fiduciary, and they are legally responsible personally for anything they recommend. Okay, so you should notice different behavior from somebody that's actually a fiduciary. They tend to put down things in writing and they want to have a basis for it. They want to have a reason for things that they do because legally they're personally responsible, whereas everybody else can hide behind the company. When you're a W-2 employee with a Series 6 or 7 license, your role is to do what the company tells you. Okay, your fiduciary responsibility is to your company. The company is the fiduciary responsibility for you. So if you as a client get upset, you have to sue the company when it's the captive agents. If it's independent, you can sue them individually and they can't hide from you behind their company. Okay. So insurance licensing, I like to tell people that if you can fog a mirror, you can get an insurance license. It is getting a little bit harder, which is nice to see, and we're starting to see some cooperation between states, because the difference between securities licensing and insurance licensing is state by state. Securities licensing is really nationally monitored and run. Okay. So insurance licensing, every state's going to have different criteria and break down the licensing differently as well. But in the advisory world, you're looking at a life and health license that includes the annuities and long-term care insurance type products. And then there's the property and casualty, things like homeowners insurance on down to umbrella and business insurance. Okay. So licensing, they have to take a test. Most people can study for a day or two and take that test and pass it. You got to be over 18. You can't be a felon. That's really what it takes. And in the good old days, you could lose your license here and go work in the next state. Lose your license there, go work in the next state. Lose your license there, go work in the next state. And so when I said that the states are starting to work together, well, that's the good thing. Hopefully we'll have this national database where we can find out if somebody lost their license and not issue a new license. Okay, so we see things improving quite a bit on this side. We're also, regulators are trying to put more of a fiduciary onus on these insurance professionals. Really, they're going after the ones that are just selling one product to any taker, the dinner seminars. So that's the licensing. Hopefully that helps. The next one in the series, we'll talk about all of the fee structures and how people get paid. So make sure you come back next week and get on that one as well. If you like all of this stuff, make sure you share it with others. Subscribe to our channel. We're adding new stuff every single week, and I hope to see you next week. Thanks again.